How interest rates really affect stock prices. Interest rates are often described as one of the most important drivers of stock prices, yet many people find the relationship confusing. You may see headlines saying interest rates are rising, followed by markets falling. Other times, rates are cut and stocks still decline. Occasionally, markets rise even while rates remain high. This inconsistency makes interest rates feel unpredictable. In reality, interest rates affect stock prices in a logical way. The confusion comes from focusing on the headlines rather than understanding how rates influence valuation, investor behavior, and expectations about the future. At the most basic level, interest rates represent the cost of money. When rates are low, borrowing is cheap. When rates are high, borrowing becomes expensive. This affects companies directly because higher rates increase interest expenses and can slow investment and growth. But this direct impact on profits is only a small part of the story. The larger and more powerful effect of interest rates on stock prices comes through valuation. Stock prices reflect the value of future earnings brought back to today. Investors estimate how much money a company will earn in the future and then discount those earnings to determine what they are worth now. Interest rates heavily influence this discounting process. When interest rates are low, future earnings are discounted less. This makes future cash flows more valuable today, supporting higher stock prices. When interest rates rise, future earnings are discounted more heavily, reducing their present value and putting pressure on stock prices. This effect alone can move markets even if company earnings do not change at all. This is why growth stocks tend to be more sensitive to interest rates than value stocks. Growth stocks derive much of their value from earnings expected many years into the future. When interest rates rise, those distant earnings lose value quickly. As a result, growth stocks often fall sharply during periods of rising rates. Value stocks, which tend to generate more cash flow in the near term, are less sensitive to changes in discount rates. This makes them relatively more resilient when rates increase. Interest rates also affect stock prices by influencing where investors choose to put their money. When interest rates are low, bonds and cash offer limited returns. Investors looking for yield are pushed toward stocks. This increased demand supports higher equity prices. When interest rates rise, safer assets become more attractive. Investors can earn reasonable returns with less risk. Some capital flows out of stocks and into bonds or cash, reducing demand for equities and pressuring prices. This shift happens even if company fundamentals remain strong. Now let's look at a real example. After the global financial crisis, interest rates were cut to extremely low levels and stayed there for many years. During this time, economic growth was moderate and uneven, yet stock markets rose significantly. One major reason was the interest rate environment. With borrowing costs low and bond yields unattractive, investors were willing to pay higher prices for stocks. Valuations expanded, especially in growth-oriented sectors like technology. Markets were responding not just to earnings, but to the low-rate environment. Now consider the opposite situation. When central banks raise interest rates aggressively, markets often struggle even if earnings remain strong. Higher rates increase discount rates, compress valuations, and reduce risk appetite. This can lead to falling stock prices despite solid corporate performance. In these periods, markets are adjusting to a new pricing environment for risk, not reacting to weaker earnings. Expectations are also crucial. Markets do not respond simply to where interest rates are today. They respond to where rates are expected to go. If rates rise exactly as expected, markets may barely react. If rates rise faster or higher than expected, markets can adjust sharply. Similarly, markets often rally in anticipation of rate cuts before they actually happen. By the time rates are officially lowered, prices may already reflect that expectation. This forward-looking behavior explains why market reactions can feel counterintuitive. Interest rates also influence investor confidence and sentiment. Low rates encourage borrowing, investment, and risk-taking. High rates encourage caution, saving, and risk reduction. These psychological effects reinforce the mechanical impact of rates on valuation and capital flows. Together, they shape how much investors are willing to pay for stocks. However, interest rates are not the only factor that matters. Markets respond to rates in the context of growth, inflation, earnings, and liquidity. Strong economic growth can sometimes offset rising rates. Weak growth can limit the effectiveness of low rates. This is why the relationship between interest rates and stock prices is powerful but not perfectly linear. In summary, interest rates affect stock prices mainly by influencing how future earnings are valued and how investors allocate capital between assets. When rates fall, valuations tend to rise. When rates rise, valuations tend to compress. But markets always look ahead, pricing not just current rates, but future expectations. Once you understand this, interest rate headlines become less confusing and market movements start to make much more sense.